Okay, while we're waiting for everybody to settle down, let me just start in order not to delay too much the events, the calendar of the day. So first of all, welcome everybody, and very happy to see that so many people chose this session over the other one. So hopefully we will have a lively discussion. Let me present myself. My name is Çiğdem Aslan. I'm part of the team which is organizing the Sovereign Debt Management Forum. And I've been working at the World Bank Treasury since 2010, providing technical assistance to governments on public debt and risk management. And before joining the bank, I was at the Turkish Treasury, head of the credit risk management. So the fiscal risks are an area that I've been working on significantly over the years. And I will introduce now the speakers. I will not give all the details of the bios. I think you do have this information. But we have a distinguished panel of speakers. So Brian Alden is the Deputy Division Chief at the Fiscal Affairs Department at the IMF. He's been with the fund since 2003, working, providing technical assistance on public financial management reforms. And also he's been heavily involved on the countries which were impacted by the global financial crisis. And before joining the fund, he was working both at the private sector and public sector on debt management issues in Ireland. And then we have Esther Finnbogadottir. I hope I pronounced this correctly. So Esther is the head of the debt management office in Iceland, and she joined the office, the Minister of Finance, in 2013, early 2013. But before joining, she's been involved on advisory services for risk, debt, and asset management in the public sector for many years. And I'm very excited to have Iceland as one of the panelists because we heard about Iceland. Iceland was on the news at the beginning of the global financial crisis when its financial system almost collapsed. And also it was on the news again when a different type of fiscal risk was realized, which was the volcanic eruption in 2010. So we will hopefully listen from her how the debt management team coped with those challenges. And then, last but not least, we have Anthony Julies. He's the Deputy Director General of the National Treasury in South Africa. He's also the head of the Asset and Liability Management Division. And so he's been an executive director at the executive board of the African Development Bank, after which he joined again the public sector to work at the National Treasury at several different positions in the ALM unit. And South Africa example also is very interesting because South Africa has sound debt management practices, one of the best among the emerging world countries. And also, they try to look at the government balance sheet from both asset and liability side. So they try to manage the fiscal risks by looking at both sides of the balance sheet. So the topic of the day, this session is about the role of debt managers in fiscal risks. And fiscal risks, as we all know, are risks to the public finances. And each time there is a downward deviation from budget forecasts, we know that a fiscal risk will have materialized. And events of the past decade also underscored that how damaging the shocks to public finances can be from the financial system, and how the public debt indebtedness can skyrocket. So fiscal risks come from many sources, and Brian will talk about it in detail. But it has become really very important to identify, assess, manage, and disclose fiscal risks. And this is really capturing the attention of risk managers around the globe. And as the party which is facing the challenge of financing the expected and unexpected losses, the debt managers have certainly a role to play. So I would like to really discuss how this role evolves and what can be done. So the presentation has three sections. First, we will talk about map the fiscal risks, which are the most important ones, and also specifically for Iceland and South Africa. Then we will talk about how those risks are managed and how they should be managed also globally. And finally, and that's where I would like to spend more time, to the role of, again, debt managers in this whole picture. We will have questions and answers. So after Brian introduces the topic, he provides an overall picture. We will have a set of questions to the panelists, after which we will open the floor for questions. Thank you very much. So without further ado, I would like to pass the floor to Brian.
Okay. Thank you very much. I'm only standing up here because I can't remember what's on the slide, so I need to see them. But I promised Chidam I'd only spend 10 minutes here, so again, I promise I won't be more than 20 minutes in discussing this. I just wanted to put in context why some of the work that both the Fiscal Affairs Department of the IMF and others have been working on over the last number of years, particularly since the end of the recent Great Recession, where people realized the extent to which fiscal risks actually, the size and the quantity of them, that were some things that they really didn't understand very well. So our most recent output was a May 2016 board paper which looked at management and our analysis and management of fiscal risk and the best practices worldwide. And the study was carried out in an environment in which countries were very unsure as to how to manage the fiscal policy challenges that they faced and the need to support demand in the post global financial crisis. They also needed to repair significant balance sheet weaknesses and build more risk-sensitive frameworks. So the intention behind the paper effectively was to help countries to develop fiscal risk management frameworks which would better understand the size and nature of fiscal risks, present a methodology for integrating stock and flow impacts. That's something I'm not going to cover too much today because I don't have enough time. And improve country ability to take account of solvency, liquidity, and interest burden, and expand the existing toolkit for managing risk. So that was the main motivation for the work that we did in 2006. We also wanted to look at how fiscal risks would actually impact on debt dynamics. Hold on. Okay, so in talking this morning, I'm going to touch on a few issues. Firstly, why do fiscal risks matter? What are the main characteristics of fiscal risks? And understanding and management of fiscal risks, and finally, strengthening and fiscal risk analysis and mitigation. So why do we think that fiscal risks are important? I think most simply, you can see from the chart here, the developments in public finances often turn out very different than we expect, and often for the worse. Let's look at, for example, at the evolution of forecasts on public debt over the last number of years. In 2007, the expectation was that debt going forward would be on a gradual downward path for advanced economies, as indicated by the dashed lines here. But the reality turned out to be very different. Debt has risen very, very sharply to a situation where it was by 2012, the actual debt levels had risen 37%, had deviated by more than 37% upwards, as opposed to what was actually originally projected. Now, some of this was an intentional response to the global financial crisis, but a significant amount of this increase was based on the fact that fiscal risks materialized and were realized over the course of the great financial crisis. So this, of course, is of very great interest to the debt manager, because obviously you have to figure out how to finance some of these unanticipated shocks. But the same was true in emerging market economies, where you can see from the graph here that, again, the difference between what was expected in 2007 and what actually happened in 2012 was a 9% GDP increase. And since then, you will see that the trajectory has continued to go up, primarily due to things like commodity revenue falls, etc. So what our basic take out of this, that most countries didn't quite understand the level of fiscal risk that they faced, and certainly didn't have the necessary capacity to mitigate them when they did actually materialize. So looking at the characteristics of fiscal risk, we did a survey of about 80 countries that looked at, as part of the analysis for the Bohr paper, and it examined the source of shock to government debt between 1990 and 2014. And the patterns that emerged highlighted 4 important characteristics of fiscal risk. First, they can be very large, and they are surprisingly frequent. For example, during the period in question, significant macroeconomic shocks, which you can see are the largest shock, cost over 9% of GDP on average. And among more specific sources of risk, such as the financial sector, which was the most frequent and most costly, followed by legal claims, subnational governments, and state-owned enterprises. In terms of the frequency of the shocks, on average, countries experienced a significant fiscal shock once every 12 years, with a large event, one costing on average more than 9% of GDP, occurring every 18 years on average. And what this really means is that in a typical person's lifetime, they're going to experience 3 very significant shocks. So the message basically is that people think that these types of shocks are once in a lifetime occurrences. They are actually much more frequent than that. The second lesson to be learned is that fiscal risks also tend to be biased towards the downside. You would expect that the forecast errors would be pretty much symmetrical on the upside and the downside, but the reality is that most of the shocks tend to be on the downside. And the reason for this is that one of the reasons for this may be that governments try to build in, they're more prone to anticipate the positive shocks and incorporate them into their forecasts, but they tend to leave out possible negative shocks in their forecasts, which leads to unexpected and negative consequences. The third characteristic of fiscal risk is that they tend to be nonlinear. And what this means is that larger macro shocks tend to be more damaging to public finances than smaller shocks. This is partly due to expenditure rigidities. It's often very difficult for governments to actually react very quickly when shocks occur on the expenditure side. So for instance, dragging down wages, for instance, or pulling down what we would term mandatory expenditures is also not very easy for governments to achieve. So it means that when revenues fall off a cliff, effectively, they are left with extreme, the shock can be magnified because governments can't react on the expenditure side as quickly as they want. It's also attributable to increases in elasticities on the revenue side, as financially distressed corporations and households try to seek out ways of minimizing tax liability. So effectively what it means is that ordinary revenue elasticities tend to break down in times of major crisis. And finally, and most interestingly, or pretty interestingly, contingent fiscal shocks are highly correlated. So as shown in the chart, when fiscal risks occur, when it rains, it pours effectively. So the average direct cost of a specific contingent liability realization is 6% of GDP, but the average increase in debt to GDP ratio over the typical event is a much larger 15% of GDP. This reflects the fact that macroeconomic downturns tend to trigger the realization of other shocks. So once a macroeconomic shock occurs, for instance, it tends to trigger other events occurring, such as financial crisis and troubles in SOEs, PPPs, etc. So as this chart shows, the losses experienced in the financial sector during the 2009 crisis were compounded by realization of risks in SOEs, subnational governments, and the private sector. So previous analysis that we did in our 2012 paper on fiscal transparency, accountability and risk also found that only about 1/3 of the deterioration of debt ratios among the hardest countries was due to standard macro fiscal dynamics, with the balance arising from crystallization of an array of other risks. And they also have broader characteristics, implications, sorry. Fiscal risk realizations can have dramatic fiscal impacts, and again, this is obviously of interest to the debt manager. So the realization of large contingent liabilities can seriously impact on absolute debt levels, as you can see from the chart in the bottom, in the top right-hand corner. And the average increase in debt GDP following a shock was about 14%. So obviously, this is something that debt managers need to keep a very close eye on. They will also impact on the fiscal balance and obviously absolute GDP, often for years following the shock. So these things don't tend to bounce back quickly, large shocks in particular. So The paper, the 2012 paper I mentioned on understanding and management of fiscal risks sought to update our fiscal transparency code, and we tried to put a much heavier emphasis on fiscal risk as opposed to the old fiscal risk, which didn't emphasize this area at all. And this was largely in reaction to the great financial crisis, when we realized that people didn't actually understand what type of fiscal risk that they faced. In the current version, the emphasis focused not just on fiscal risk disclosure and analysis, which is where most people have concentrated their efforts so far, but also on risk management practices. How do countries analyze and mitigate the risks that they face? And also looking at countries' ability to analyze and contribute and coordinate their fiscal policies across all government levels. So how do central governments, for instance, and subnationals and the wider public sector through public corporations coordinate their activities to ensure that fiscal risks are being managed appropriately? So many of these areas are of direct relevance to the debt manager, which I've marked in green, or in red, sorry, with the others often indirectly impact. So, for example, when changes in macroeconomic assumptions, asset and liability management, oversight of guarantees will impact directly on debt management strategies. Other risks emanating from things like PPPs, subnational government, and public corporations can more indirectly impact through, for example, often unanticipated requirements to assume or issue debt to bail out distressed public sector entities, as witnessed by many countries during the great financial crisis, including my own Ireland, where this was a major issue. Although we believe that the Fiscal Transparency Code contributed to raising awareness, we also thought that it didn't go far enough in helping countries to understand what they could do to actually analyze and mitigate these risks. And this was the main focus of our paper in 2016. So maybe looking at some specific areas, when it comes to contingent liabilities, looking at the quantification and analysis of risks, we found most countries only provide a qualitative discussion of potential risks that are forecasts in their budget documents, and only about 16%, which is a very low percentage, publish a quantified fiscal risk statement estimating the scale of potential exposure. So what this means is a lot of countries are now beginning to produce fiscal risk statements, but they're actually just talking about descriptions of what type of fiscal risk they face. Very few countries are actually quantifying them or offering a probabilistic assessment of how likely they are to occur, basically. So this is an area where we feel that many countries have a lot of work to do. The other thing that we discovered in understanding and management of fiscal risk is that mitigation efforts tend to be ad hoc, fragmented, and focused on relatively blunt instruments. If you take government guarantees, for example, as shown on the chart, most countries, or a majority of countries, impose limits on either the stock or the new issuance of guarantees. So about 60% of countries do so, but only about 1/4 charge risk-related fees, for guarantee fees, for instance, and only about a further quarter reinsure or securitize their guarantee loan portfolio. And only about a third either expense or set aside a provision in the budget for expected calls on guarantees. The results of this survey suggest that there's considerable scope for countries to do more and to do it better. And this, again, is an area that I think has become very much a focus, not just of the IMF, but of many of the actors in the international community over the last number of years. So I'm going to finish basically. As part of the paper, I'm not going to discuss it now because I think I've sort of talked too much at this stage. We did develop what we call a fiscal stress test, which was some way of helping countries to identify the level of fiscal risk that they face, and also to understand what type of measures they need to take to counteract them based on country-specific circumstances. But I can discuss this with people later on if they want. But one of the other things that we did in the paper was try to help countries to develop what we call a fiscal risk management toolkit, which looks at 4 steps in the whole fiscal risk management process. The first step we focused on was identification and quantification of the sources of risks, their magnitude and likelihood of realization. The second was to assessing whether steps could be taken to mitigate these risks through different types of criteria. And we have, it would be, if you are interested, it would be good for you to read the board paper that we produced. And again, I can reference it for you if you want. And basically to mitigate risk to direct limits on exposure, indirect measures such as regulation of risky behavior, or by transferring and sharing risks. And many countries have looked at risk transfer mechanisms. For instance, you look at countries such as the commodity producers. Mexico, for instance, hedges its oil exposure. And you can look at catastrophe bonds in the Caribbean, for instance, which look to mitigate some of the risks associated with disasters, etc. So there are different and growing number of instruments that are being looked at and put in place to try to mitigate against major risks. The third step we looked at was provisioning. So for those risks that countries were unable to actually mitigate or unwilling to mitigate due to cost factors, for instance, there's the idea that they should be setting aside provisions in the budget. These are more appropriate for continuous risks that tend to happen on a frequent basis that you understand are likely to happen over the course of the year, either through including contingencies in the budget or establishment of buffer funds for those risks that have a likelihood of occurring over the medium to long term. And finally, for those risks that either from a cost perspective or through a risk management decision as to the level of risk that is acceptable for governments to bear, the fourth area we looked at is how to accommodate the residual risks that countries face. So there may be good reason for countries to adopt risk, but there is also a need to ensure that you don't actually impact on your debt sustainability, for instance, by realization of some of those risks. So some of the work we did in the paper was looking at how you could look at what we would call things like safe debt levels which would ensure that with a reasonable level of confidence you wouldn't enter into an unsustainable debt position which would lead to explosive debt dynamics. So a lot of this work is still ongoing, but I think all I was trying to do today is put into context the type of work that's going on and what sort of work countries need to think about in broadening their risk management analysis and mitigation efforts going forward. So I'll stop there, but I'm sure we can have a conversation going forward. Thank you very much.
Thank you very much, Brian. This is a very good summary, and I will take it from the place you left. It is true that the broadening the scope of the risks that are managed by governments, I think it's one of the key aspects, because as finance ministries or treasuries, or more particularly debt management groups, we tend to focus more on loan guarantees, public-private partnerships, and we don't always look at the big picture. So I think it's important to be able to follow this fourth step and then see how to manage in a broader sense. So now I would like to start by asking Esther and Anthony to talk about what are the key fiscal risks in Iceland and South Africa for you. And then we will continue elaborate more on how they are managed, etc. So please, Esther.
So now you are meaning today. What challenges we are facing today?
Today, and of course you can do a brief summary of what happened, but about 2-3 minutes so that we have room to discuss
I think,
more
for history, it's very important to mention at least the crisis and how we dealt with it. Because in 2008, Iceland was in a fairly good shape with a debt to GDP level roughly around 20%. We had a fiscal surplus over a decade or more. So, and the economy was growing, everything was looking fairly bright. And what happened then, the collapse of the financial sector was not foreseen. But of course, or maybe, of course, it should have been, more focus on it and more attention on it, because the financial sector was 12 times GDP. So for Iceland as an economy, it was a huge fiscal risk sitting there in front of us. But things happened. The banking system collapsed. Iceland's debt to GDP ratio went almost overnight from 20% to 90%. Revenues fell like this, expenditures up like this, and I think the deterioration of on the fiscal budget was around 16%. It was a huge challenge we were facing at the time. Most of you must know that we went into the program with the IMF, so we had quite a lot of help at the time to dealing with the crisis. And for 2 or 3 years' time, I think we were really just dealing, how to deal with the extreme situation we were in. But time passed, and luckily we kind of faced another disaster or a very, which is a very risky factor as well. But we had the volcanic eruption in 2010, which really has helped us out of this crisis, because tourism has been growing on average 20 to 30% yearly since. So fiscal risks can be kind of positive as well, at least in our case. So, but of course, as we are today, you could actually argue that that is kind of a risk today, how important the tourism is for us now. Their share in export income has actually grown from 20% to over 30% in just 5 years' time, which means that the fisheries and the energy-intensive sectors are less important than they were. So if we will see a huge decrease, it will definitely affect us very sharply or very negatively. But I would say, on general terms, what we see maybe as our major fiscal risks today are contingent liabilities. That's one thing. We have a huge amount of state guarantees, around 50% of GDP. However, they have been decreasing quite a lot over the past years, and we have also been taking some actions in order to bring them down. But pension liabilities is also quite a risk factor. That is, pension system in Iceland is very, very strong. We have almost fully funded pension system. Their asset base is around 160% of GDP. So, but we have a small risk that is related to the state pension funds, which is not fully funded, and we see that as one of our key risks as we stand today.
Thank you. Anthony?
Peter. So for South Africa, when we were affected by the crisis in 2008-9, and we then had a lot of fiscal space to use the budget to get the economy to grow, we did that. And it was a very deliberate strategy. We then decided that we will spend more in particular on infrastructure. And as a result of that, of course, then the expectation was not that we would have this delayed recovery in the global economy as well as in the domestic economy, but we spent quite significantly, both as government into infrastructure, social infrastructure, and therefore incurring debt in an environment where the economy did not perform, and therefore the higher deficits that we were able to absorb at the time, we thought, right, coming from a tiny surplus that we had just before the crisis, as well as giving guarantees and support to state-owned companies, particularly into infrastructure. And so we saw a significant growth in that expenditure, social infrastructure, and therefore the debt levels growing, as well as the guarantee portfolio to state-owned companies, in particular the energy utility in South Africa, Eskom, and in the road infrastructure, South African National Roads Agency, etc., but in a number of infrastructure. Now that I'm giving that as a backdrop, and so the key risks that we have essentially now is budget execution risks. So when the minister presents the budget, the ability to execute that budget in an environment where, notwithstanding having a ceiling on our expenditure, the revenues underperform as a result of the growth environment, and therefore continued slippage in the debt to GDP number. And so the execution of the budget. Then we have serious, the state-owned company exposure to state-owned companies. Given the growth in the debt portfolios of state-owned companies, even with support, equity support to them through government support by selling off non-core assets that we've been able to identify, the financial position of these entities have over time increasingly deteriorated. And therefore the quality of our exposure as government through the guarantees that we have provided the state-owned entities for the debt that they're incurring has also deteriorated. So that is a second very big risk, a fiscal risk. And then more generally, just the macroeconomic risks, right? So linked to the global environment and the Brexit and the developments in the US, that we're all familiar with. And then also what it means to the UK, what it means to the EU, and what it means for trade with South Africa. And so the uncertainty that we have, as well as the need now in South Africa to undertake the reforms, because we've essentially run out of space on the fiscal front, because the budget numbers are at levels that we are not comfortable with, debt to GDP. Monetary policy has run out of space, the accommodation that has been provided by the monetary authorities. And so the emphasis now is on reforms. And in an environment where you need to accelerate reforms, you really go to the heart of what every country ought to be doing, and that is the reforms agenda. And that is why you have the situation that we had in South Africa in 2015, December, right, where we had 3 finance ministers over a period of 4 days, being the finance minister in South Africa. It's an agenda that is a necessary agenda, the reforms agenda, which is a very challenging, very difficult. But so macroeconomic risks, socio-political risks is another big risk.
So they were the ones with the highest impact on the chart Brian showed. But also I think you have public-private partnership kind of guarantees as well. So when you talk about guarantees, do you include those as well?
So the public-private partnerships, we have incorporated that into our portfolio of guarantees. We've also now incorporated into the portfolio the exposures that we have to the independent power producers. So part of the public-private partnership arrangement, we have also provided guarantees to Eskom, who have entered into contracts with the private sector for the renewable energy program that we have in South Africa. Given the load shedding that we've had some time back, the inadequate demand for electricity exceeding supply, and therefore the need to ramp up energy generation. And the renewable energy program was identified as a priority. And therefore we collaborated with the private sector. That in itself to date has added 200 billion rands to our guarantee portfolio. That is the exposures that we have guaranteed as government to Eskom, that Eskom is contractually bound to purchase from the private producers. But there is also a contract between Eskom, the electricity utility, and the regulator, the National Energy Regulator of South Africa, that the tariff methodology and the tariff adjustments, electricity tariff adjustments compensates for that guarantee, and therefore the likelihood of default is in a way mitigated.
Okay, so this is Actually, this brings me to my next question about how to manage these risks. So Esther talked about the financial sector risk which has materialized, and I think Iceland went through a series of reforms for the financial systems. And you are also talking about guarantees, and Anthony talked about the state-owned entities as one of the biggest source of risk and the macroeconomic risks. So how are those risks managed in your countries? And also, then maybe Brian can provide. You don't have? Okay. Then we will continue with Anthony and Esther for the time being. Yes.
No, I'm joking.
Well, if we just focus on those three, there have been several reforms made, and policy oversight, so to say, has been changed very severely. The financial sector is very, or has very limited scope today as both for growth as they used to, and we have been implementing more or less the European banking regulation well in steps. But we have, they are faced with high equity ratios or high equity levels, net stable funding ratios, liquidity rules are more strict than before, etc. So,
if I just may add, whether the Finance Ministry and the Debt Management Office is involved in the financial sector reforms or not.
The financial the financial sector is of course supervised by the FSA or the financial regulation in Iceland, but the central bank is actually more or less setting the space or the scope they have according to their rules. But of course we have because we have the state or the treasury now owns two of the major banks in Iceland. Fairly recent development, but so we have and actually an indirect interest in the third one. So we are quite concerned about their performance and this industry in general. So we follow up closely, but we have there is an organization or a company that we called the Icelandic Financial Investments, which is kind of a holding company that holds the shares in the financial institutions, and they are keeping very close eye and monitor and follow up on things and report them to the ministry. So I think the financial sector, as I say, the banks are in very good shape. Equity ratios of 25 to 30%. We are not really concerned as we are today. However, having those large banks on our balance sheets is not maybe a very good idea for a longer term. It hasn't been the most, how do you say, the political consensus about this or in Iceland. So we haven't seen any strategy in withdrawing the holdings in those banks yet. But we have elections in just a few days, so we'll see. Hopefully we will reduce that exposure and that risk in one sense or another. Regarding the state guarantees, there is a state guarantee fund that is monitoring the state guarantees, which is part of the government debt management unit in the central bank. And as I mentioned before, that's another thing, because 75% of those outstanding guarantees we have is to the State Housing Financing Fund, which has been, or more or less was, the major player in the housing lending in Iceland. However, that changed quite a few years ago, and now the banks are more the major player in that market. And so their lending has decreased quite a lot, and as their funding has the government guarantee, it all has amortization profile, so it's been gradually reduced. And we are also foreseeing that the role of the fund will be more like a social or more like a social player in the future, and more on research and information collective base. So we have just a small PPPs, which we are not very concerned of. So I think, yeah, this is more or less what I have to say about that.
First, let's listen to Anthony, and then Brian has some comments. Yes.
Thanks, Shida. So on the budget execution risk, what we introduced was an expenditure ceiling on non-interest expenditure of government, and that was approved in Parliament. But we've realized that even though we've had that ceiling, that the underperformance of the economy has resulted in underperformance in revenue, and therefore continued slippage, and therefore debt continuing to rise. We've then also now introduced the term of fiscal neutrality, so that whenever there's a need for any unexpected, especially huge expenditure, like recapitalization of entities, that it would be done on a fiscal neutral basis. So that means that one would need to identify resources, revenue, either identify any assets that may not be core to government and sell in order to meet the expenditure that has been unexpected and required. And therefore, it's still fiscal neutral in terms of the fiscal budget, but technically it implies that you've in fact breached the expenditure ceiling, but the term fiscal neutrality. So that's on the budget execution. And we have been able to sell quite significant shares in Vodacom, and that was allocated to Eskom as part of an equity injection. But on the SOCs, and this is a huge exposure in terms of the guarantee, there's the reforms. And so we are looking at 3 areas in particular: a framework to inform how to identify which assets of government are non-core, and therefore putting a framework in place. Already we have approved framework by an interministerial committee, and it's now left to cabinet to approve. We have a framework also improved by an interministerial committee on separating the costs for the developmental mandate of state-owned companies versus the commercial mandates of state-owned companies, because currently it is very easily argued that when entities incur losses, that it's due to the mandate given to them by government. And therefore, being able to separate a framework we have done, it's for cabinet now to approve that framework. And thirdly, an important framework is a framework on private sector participation. Now, a lot of private sector participation happens. The Independent Power Producer Program is an example of that. But having a framework in place that informs when and how you involve the private sector, because in a very politically charged environment, any notion of private sector is interpreted as privatization, and politically, Leslie, you will know it's very sensitive when we talk privatization. Nothing can be privatized. But there are many models that one could look at for that. So those are the kinds of things that we are looking in order to mitigate the risks.
I just wanted to add, I think based on what I was saying in the presentation, the reality is that many countries don't manage or mitigate risks well at all. Some mitigate certain risks but don't look at others. And there are actually very, very few who look at it from a holistic balance sheet approach, that look at the risks that they face on an overarching basis. So that's one of the things we've been trying to work with. One of the exceptions may be New Zealand, who actually are beginning to look very much at a balance sheet approach to identifying and managing the risks that they face. And they will say that they're not at the end of this journey yet, but they're certainly more advanced in many of the other countries that we've faced. What we saw when we did the research into the paper was that, certain countries are very good at certain things. So for instance, if you look at the Swedes, they're very good at managing guarantees, for instance. If you look at the Icelandics, they have a very good framework in place to manage the risks from subnational governments. That's been put in place over the last number of years. Equally, Anthony was just talking about SOEs in South Africa, which again, although the risks are large, at least there's a good framework. And I mentioned Mexico doing a lot of work on the hedging of their oil-related exposures. Chile is another example that does things very well on PPPs, for instance. But if you ask all of them whether they understand all of the risks that they face and whether they're mitigating all of the risks that they face, the answer is, in many cases, is largely no. So what countries really need to do is, first of all, understand the breadth of the exposures that they faced, and then basically to put in strategies to actually mitigate them. And that requires a level of coordination across government entities and through the wider public sector that we don't see in very many of the countries that we've been discussing this with.
Can I mention one thing? Because there's you mentioned how we deal with the subnationals. There was actually a law passed at the end of last year. We call it the organic budget law. Mm-hmm. You might have heard of that. So that is both increasing coordination between the central government and the municipalities, and looking at the broader picture. But it's also, it has completely changed the whole budget policy framework and how it's done. We are now facing with to present a 5-year plan. It was the first one was presented last spring, and we have fiscal rules now that we have to comply to, and these kind of gives us much less scope for deviations from the budget, and the budget execution, I say, is much less risk than it was, or used to. Yeah. So.
Okay, so those are very good points, and I think I fully agree that some countries are very good in managing certain kind of risk, and that's probably before they suffered from those risks in the past, which is why they tend to address more some of those risks. And then I also agree that to identify the risks is also more or less done. I think countries do publish or at least internally develop fiscal risk statements. But the question is how to quantify those and who will do that? Who will do this, prepare this fiscal risk statement? And what should be, so I would like to just transfer slowly to the role of debt managers. So given their exposure to risk, given their ability to work with the markets, being familiar with the implications in the budget, and also debt managers don't like surprises, how should they be involved in this overall fiscal risk management discussion? So the floor is open to all three of you. Maybe we will start with Anthony.
Thanks, Shidam. The role of the debt manager when it comes to managing the fiscal risks is certainly that that debt managers are very familiar with why they are doing what they are doing, right? What's the purpose for the work, the debt management work that they are doing, and bringing and connecting it to the overall strategy of government, right? So when we say as we have a national development plan in South Africa, what does that translate to for the National Treasury? And if the National Treasury then says 3 key objectives for the Treasury, is that we should achieve debt sustainability, we should achieve counter-cyclical fiscal policy, and we should achieve intergenerational equity, broadly speaking, as the Treasury in this post crisis environment. The question then becomes, how do you link those three objectives as the Treasury to debt management so that we understand the role of the debt manager? So as an example, when we say intergenerational equity, it should be understood that when we incur debt, it cannot be debt today for the current generation. It will be debt that we are incurring because we need to, an asset that must be acquired from that debt, and that asset is something that should be of a long-term nature, meaning the debt should be of a long-term nature, and therefore we are the need to have deep capital markets in order to raise 30, 40-year debt, intergenerational equity, so that the future generations can benefit in future of the debt that you're incurring today. Debt sustainability, very clear that when we have the benchmarks on the composition of your debt, the whole discussion we had yesterday, Shidam, around the design of debt strategies, but also the levels of debt and levels of contingent liability, that you achieve levels that are sustainable and therefore linked to the fiscal framework. The advantage that we have in South Africa is that, we don't have a debt management office that's independent. And I think when it gets to reforms, and you have to push a reform agenda, that's when we have the advantage, although we are not, paid as well as the independent debt management officers. But being within the Treasury, day before yesterday, I sat in a meeting where the minister was now planning the statement that he will be delivering next week for the medium-term budget policy statement. And what's the dynamic, what's the narrative? And being a debt manager, we're able to participate in that discussion that informs even this statement that the minister will present. When it comes to raising taxes, do we need to cut expenditure? Where do we reprioritize when we are faced with challenges? And what is the potential for more debt in an environment where we are always being faced with the rating agencies looking down our backs, right, and negative outlooks. And being part of a discussion like that is a very big advantage of being a debt manager within and close to the reform agenda of government.
Well, I totally agree with many of those things, Anthony, but mentioning the rating agencies, that's one of my concerns, at least, to bring the debt levels down again, and I think we are doing quite a good job at that, down to 50% now, and we will be down to 30% in just 5 years' time. And benefited already from it by an upgrade from Moody's up to an A category again, which is quite a pleasant development. But I would like to add, because of course we are probably more on the qualitative side than the quantitative, and of course we have a lot of things we can improve, and a lot of things undone in fiscal risk management in Iceland. However, and I think, even though the role of the debt management is very important, I think this has to be a combination or like a teamwork involving people both from the budget department, asset management, economic department, revenues, etc. So I think some kind of a framework would be sensible or a team framework to develop in that sense.
I think basically the debt manager has a number of roles, and very important roles. In terms of obviously, analyzing the risks surrounding the debt portfolio and the contingent liabilities is one that is obviously the role of a debt manager, and also ensuring that debt management strategies are fully aligned with fiscal strategies, basically, so that there is like a lot of people talk about debt managers' role in bringing the debt down. They don't have a huge role in bringing the debt down. That's a fiscal policy decision as to what the sort of level of the deficit and the level of debt should be going forward. But what they can do, obviously, is indicate what the implications of government decisions in this area are. So I think that's a very important role of the debt manager, is developing their capacity, their risk management capacity, to offer advice to policymakers surrounding both the debt and the contingent liabilities associated with borrowing, such as guarantees, etc. I think they also have a role in mitigation efforts as well, because as I mentioned before, increasingly countries are looking at ways that they can transfer risks, arising from various different types of scenarios, disasters, through catastrophe bonds, hedging through using derivatives, etc., etc. Because there are very few people in the public sector generally who have this type of experience, often it lends itself to working with debt management, the debt manager, to actually determine how these types of risk transfer or risk mitigation strategies can be implemented. And I think the debt manager has a very important role to play in that. I think finally, I'll add another one subsequently, but another area is in an advisory capacity. I think we've been seeing this in a number of countries, is that the debt managers, because of their expertise in the financial markets or their knowledge of the financial markets, are being asked to broaden their policy advice in many areas. The example I would give is in my own country, in Ireland, where they're now actually looking at advising the NTMA, the National Treasury Management Agency, also offers advice on things like infrastructure investment and public-private partnerships and the risks associated with the types of contracts that they're entering into there. So because of their experience of the financial markets, they have a role to play in helping other parts of the public sector in determining what type of instruments are safe or what type of risks they are actually undertaking. And finally, from an institutional setting, I don't think the debt manager is in a position to be able to coordinate the risks across the wider public sector. So they have a role in coordination with other players. I think, generally speaking, you're looking for a central fiscal agency, such as the Ministry of Finance or Ministry or like-minded agency, to coordinate the fiscal risk reporting and analysis function. But the debt manager obviously has a very crucial role in feeding into that process as well. So, and again, it's very country-specific. Anthony was mentioning the advantages of not having a separate debt management office. I'm sure there's others in the room who will say that there are many advantages in having a separate debt management office. So again, it depends on country circumstances. There are costs and benefits in all of the different models that are being used. But I think certainly from talking about the role of a debt manager, he's one of the key players in this sort of function.
Wonderful. And also I would like to just coming back on the issue of debt sustainability versus debt management. We have the last breakout session of the forum. It's on that relationship precisely, and my colleague Abha Prasad will be monitoring that. So if you are interested to hear more about it, please come back to that session. Okay, so we have about 10 minutes to finish this part of the presentation of the panel. So let's move forward to going forward. I mean, we said those risks which are better managed are the ones which happened. So going forward, what are the risks which worry you most globally and also, specific to Iceland and South Africa? Maybe you can respond to this briefly.
Well, I think, of course, on the global scene, we are seeing, of course, issues like on the political scene, the Brexit, for instance, natural disasters. That, of course, is a concern of Iceland in a way that, like the Brexit, for instance. The UK is one of our largest trading partners. The number of tourists from UK are around 19% of the total tourists. So, of course, we are concerned about that. So, I think we are very much aware of the risk globally. But as I say, if we just look at those specifically in Iceland, which we are really most concerned about these days, are these unfunded pension liabilities and contingent liabilities, and if of course the general economic conditions, because if as I say, the tourism, if there is a drawback there, we will probably have a huge drawback in the economic growth. The
biggest risks in South Africa is, I think, the the procrastination with the implementation of the reforms, right? The reform agenda. Social, political now, because I don't want to get into politics because I'm not mandated to talk about politics. But when to drive an agenda, a reform agenda, whether it's labor reforms, whether it's the state-owned company reforms, whether it is the budget execution, being able to deliver on the budget execution, reprioritization of expenditure, achieving that in an environment where we have huge risks, and therefore that links to a big risk around the ratings, the rating agencies. I don't know whether they are present here, but we will hear S&P and Fitch will announce towards the end of the year on whether we either maintain or move to a different level on our ratings, and the implications of that for the again for budget execution on the cost of servicing our debt. Should we then be downgraded? So that would be the big risks.
Up until recently, I would have said the financial markets are probably the biggest risk, but many countries have put in place mitigation measures to prevent governments from bailing in financial institutions. It'll be interesting to see whether how effective they are if there's a new crisis in the future. But certainly, I think the risk from the financial sector has reduced dramatically. Broadly speaking, the biggest risks I think most countries still face are on the macroeconomic side. They dwarf everything else basically. So if there's a major macroeconomic shock, it tends to impact on revenues, and falling revenues are the really big thing that hit governments the most basically, because of the issues surrounding expenditure rigidities that I spoke about earlier, and they tend to be much larger than the other risks. It doesn't mean that they don't compound the risk. As I said, fiscal risks tend to be very highly correlated. They all tend to happen at the same time. So if you have a major macro shock, a lot of other things tend to happen. But if I was to wish away a risk from a country, I would say focus on the macroeconomic side, because that's where you're going to get the biggest shocks, basically. But obviously that's not to say that you should be ignoring any of the others, because obviously many countries have, and it's very important that countries look at the specific risks that they face, because some countries, like for instance Iceland, you mentioned the Housing Finance Agency, it's a declining risk, but it's still one of the biggest risks that you face. In other countries, that mightn't be such a concern. It might be something else, basically. It might be the size of the PPP portfolio. So it really depends on country-specific issues, but in most cases, the macroeconomic shocks are the biggest ones to worry about.
Thank you. Actually, I had one more question, but I'm told by my colleagues that we will have to slightly shorten the session. So maybe we can, because there are so many issues to discuss, so maybe we can open the floor for questions so that we do have a chance of discussing and hearing from the audience comments or observations or questions. So the floor is open. Yes, Edgardo and then Luis.
Thank you very much. See, then just to share with you and with our colleagues that we develop. I'm from the Inter-American Development Bank. Yeah, we just developed a toolkit to identify most of the sovereign contingent liabilities and to have a first estimate of several of them. And we just published that toolkit in English. A couple of weeks ago. So perhaps that could be something useful for you to have it, to take a look. And the second thing is that we just finished our meetings of the Latin American and the Caribbean debt managers group. This of course was part of the discussion, and we received from some of the countries the idea that we start collecting some information about the contingent liabilities. Of course, there is a problem of comparison because of the methodology, but it's something that we are looking forward to help our countries and our membership on that. Thank you.
My name is Luis Alton. I work for the Disaster Risk Financing and Insurance Program. And I was obviously struck by the comment by Esther about how the recent disaster was a positive fiscal risk, I guess. And maybe I should put in a word of caution saying that usually that's not the case. I think most countries who face big risks from disaster, they face negative risks. And just to comment that a lot of the issues that were mentioned about fiscal risk in general apply to disaster-specific risk as well, including on identifying the contingent liability, which is a huge problem in many countries, including knowing which assets the government has and which are at risk, and then putting in place financing strategies which are coherent, strategic, so you don't have to deal with the materialization of risk in an ad hoc way. So the World Bank provides technical assistance in that domain, and also provides financial products, actually. That we have contingent credit lines which specifically address disaster risk. And I would actually be curious to know from Esther how Iceland deals with that. If you have any specific products in place to deal with disaster risk or contingency budgets, etc.
Yes, we have. The Icelandic Catastrophe Insurance Fund is actually the case that is handling those issues. Well, in the past, there is a mandatory insurance on every housing and every and all kind of like bridges, harbors, whatever, and so that is mandatory, and a part of regular insurance actually goes into that fund. So and they have a permit of seeking funding from outside if necessary, but they are of course their asset base is increasing every year by I don't know how much, but it's a limited amount, but so they have been growing. We have been lucky, in those cases. We with those disasters in the past years. So I think in general I would say we would be mostly covered. But as I say, there is the fund can seek outside funding if necessary, but also, and in some cases in the past, the government has stepped in. Like for instance, we had a really bad weather in a certain part in the Nordic area 3 years ago, I think, and that was very limited to farmers in a certain area, which lost a lot of their herds. So, and they got or were provisioned by the government, in special funding. But but this catastrophe insurance fund is really taking that risk.
Thank you, Herman.
Thank you for the presentations. I wanted to touch upon a theme you raised on the role of credit rating agencies. I think that goes to the heart that it's not only how the managers quantify and perceive fiscal risks, but it's also how the investor community is perceiving it. And because in the end, it ultimately goes to the perception of sovereign creditworthiness. So my concrete question is, in your interactions with credit rating agencies, what's the discussion on fiscal risks? How much weight do they give? And especially, how do they consider this risk mitigation policies? I think there is a role for multilateral organizations, not only to raise awareness of fiscal risks, but to make sure that credit rating agencies reward those countries that actually take measures to mitigate them. My sense is that this has not been completely factored in by credit rating agencies, and thus do not provide much incentives for countries to actually take those measures.
Right. Thanks for that question. Certainly, when you talk to the rating agencies in the environment that we are in, it is about how do you get our economies to perform. What is it that you've got to do to get the economy to grow at higher levels, right? And therefore, they understand that it is not that they would want to see the GDP climb today, but are we doing and are we implementing measures today that are sufficient? And in terms of that perception, sufficiently confident that economies and governments are on the right track, so that the economies will perform better. And therefore, it is about, are we delivering these reforms we have said, And for South Africa, it's not only now, but this is what has been communicated. We will do this. We are committed to this. So this is why I was making the point about procrastinating. We are procrastinating. And that's the risk, because we could understand rating agencies and investors then saying, whilst you may have had credibility in the past, what you are saying now, if you are failing or you are lacking in words to say the same thing that you said earlier, your credibility is affected. And you, in a way, it justifies if that we are then unable to maintain the kinds of ratings that we had previously. So it is about that confidence and implementing these reforms. So because that gives confidence, we in situations in South Africa, where the private sector is also sitting on cash. A lot of investors are sitting on cash, waiting for that one economy, especially in the presentation we had earlier about emerging markets is where growth will be coming from globally. And investors are sitting on cash. Any country, emerging markets in particular, that demonstrates that here is a serious commitment to implementing the reforms agenda, I am convinced will be attracting significant inflows into the country. And this is very important in the South African environment.
Yeah.
Have you, just the methodology of credit rating agencies, mean that they properly assess the reform?
So am I happy? Because it's not increasingly, investors are also doing their own assessments. And they're also now challenging the rating agencies. And South Africa is also doing its own ratings assessments. And our internal work is used to engage the rating agencies when we meet with them. Is there alignment? Or is there no alignment? And if there's no, that's the nature of the discussions that we have with the rating agencies. And so we do appreciate that they need to have capacity and skill to do their assessments, but increasingly investors generally are also doing their own assessments. But debt managers and national and governments should also introspect and do their own assessments in order to, so that it's not, we don't do to satisfy the rating agencies, we do in order to grow the South African economy and achieve better outputs for the citizens of your country. And it should be that should be the motivation, and increasingly it's about, are we pleasing?
Yeah. Well, I think, of course, in our case, the major concerns of the rating agencies for the past few years has been, of course, the fiscal situation, which is clearly on a positive path today. We are on a budget surplus. The economic conditions in general, we have almost 5% growth this year and foresee 3 to 5% in the coming years. The third one were contingent liabilities and mostly the housing financing fund. I would say that maybe they haven't fully accomplished or no, fully rewarded us for those actions we have taken there, or still are some steps left, but it is at least a lesser issue than it was. The fourth and the most important one probably is the capital controls. That was, of course, Iceland had to implement capital controls in late 2008, and the government or the authorities released a strategy plan last year in order to lift those, and that was really appreciated by all the rating agencies. So we have, I think, I would say, in some way, been rewarded for those steps we are taking in mitigating those risk factors, but not entirely.
Also, maybe the rating agencies do prioritize the fiscal risks, and they remunerate the steps taken to mitigate some of them more than the others. There was a question, yes.
I am László Búzás, consultant in public debt management, former deputy head of the Hungarian Debt Office, and what I wanted to say that I fully agree with Brian's comment on the major risk coming from unfavorable macroeconomic developments. At the same time, as a debt manager, I would like to point out the risks we are facing with deterioration in the financial system. So this is something which is not guaranteed by the state. At the same time, no country can afford a meltdown in its banking system. For a public debt manager, it means it's a huge risk. First of all, there will be an increased demand from the government to raise debt and put money into the banks. You as a public debt manager lose a part of your intermediation because these banks, most of all, turn up as primary dealers in your market. And third, they may be investors. So any problems in the banking system means a huge risk for the public debt management. And I think that this is something we do not stress enough when we talk about fiscal risks.
Thank you. I wouldn't disagree with that. But I think that's what the point I was making is that many countries have tried to put efforts in place to mitigate the risk from the financial sector, but I'm not sure that every country is in a position to say that they've mitigated away those risks, basically. So I wouldn't disagree with what you're saying.
Arvin.
Yeah, sorry, I just want to take this opportunity to bring your attention to some work that the IMF is currently doing, specifically on state contingent financial instruments. This is related to the theme of managing fiscal risk, but we are focusing specifically on a set of instruments which we think might have a role. And by state contingent financial instruments, we mean any instrument, any financial instrument, whose payoff is a function of an economic variable or financial variable. And in terms of debt instruments, we typically think of maybe a GDP-linked bond or a commodity-linked bond. Of course, this is not the first time. These aren't new ideas, and it's not the first time either the fund or the international community has explored these instruments. Almost a decade ago, the fund pushed for these instruments, especially GDP-linked bonds, but there was little appetite both from investors or from issuers. But then the question is, why do we think we should raise these issues now? Why do we think that these instruments might have a role now? Well, as Brian has pointed out in his, and we've discussed, several countries have much less fiscal space. Debt to GDP levels are very high in several countries. The low interest rate environment might actually make these instruments more attractive to investors because in the good times they offer an upside which can offer higher prospective returns. Those are some of the reasons why we think it's important to look at these now. Now, what are we doing specifically? As it relates to you as country sovereign issuers, we are conducting a survey. Several of you have already received a questionnaire from us asking you to fill in some information regarding your use or non-use of these instruments and what are your views about them going forward. I want to say thanks to those who already responded and returned those questionnaires, and to ask those who are still to do so to kindly do so. We also engage with the investors. We have spoken, we are consulting with investors to get their views and feedbacks about the usefulness of these instruments for their portfolios and so forth. And the fund is going to, as part of this whole process, produce a board paper, which is probably going to go to our board by the fall of next year. Sorry, not the fall, the spring, by April, end of April next year. And also we have been mandated by the G20 to report back to them on the role these instruments can play in helping to improve the international financial system, as mechanisms to reduce or reduce crises. Thank you.
Thank you. There was a question, yes.
Thank you very much. My name is Samuel Akes from Ghana. I think I came to this session to see if I can have some hope, but I've ended up being a bit more worried with more answers, and maybe because I think the risk has been hugely summarized for those of us who are managing things in a sovereign angle. I heard hints from a colleague from South Africa There are other risks that does not follow even all of this, but appears on a macro. It may be social, maybe cultural, maybe even election, having very huge macroeconomic fundamentals that you will not have any idea to go. But I still recall, I think, a statement from one PFM expert who said, you can never implement rightly a wrongly prepared budget. If I use that notion here, we are facing huge risks at this stage, where if I look at the variation of, I was amazed about what Brian showed, and I'm sure it's the IMF who did that forecast 10 years ago. The huge deviation from expectation to actual shows that the risk is even everywhere for all of us who think we have the expertise to identify the risk. The question here now is, what is our role as debt managers at this stage, where Brian has shown succinctly that all the thoughts, all the best brains, the actuals have departed largely with regards to even identifying the risks. Look at Iceland, our colleague, what she mentioned. I'm not sure they had an iota of knowing that within a year or two, debt will have gone up so hugely by just one shock. So I still want to find the answer. What is our I mean, we can't do the same thing and expect different results. What is our debt manager supposed to have now going forward? What is the role, the critical role that we need to do?
Great question. So I will attempt to give an answer, and then we can ask the panel. I think the first thing is to do your job well. So to finance the financing needs in the best way possible. So we were discussing this morning, for example, development of the local bond market, to be able to rely on that when the risk hits. So that's one thing. But the other one is, again, coming back to what Brian was saying, it's one step at a time, right? I mean, the macroeconomic risks are always there. Maybe they are more significant now than at any other point in time. But at the same time, I think it's important to have an overview of the significant risks for your respective countries and try to address them one by one, quantifying, providing informed decision, helping decision makers to take informed decisions. So I think those are, and for debt managers, the most obvious one is, as we were saying, the loan guarantees, the public-private partnership guarantees, to some extent, state-owned entities, subnationals. So those are the most immediate ones, but also using some of the different financial products for disaster risk management. So it's really one step at a time. But, yeah.
Well, I think at least what we are trying to do in Iceland is, and I mentioned, one of my priorities is to pay down debt, because then we will be in the position to take on additional debt if necessary, as we were in the case of or before the crisis, and as well bringing down the interest costs is very important as well, because. That is actually a huge part of the budget still in Iceland, and if we bring that down, we make room for something else. So that is actually, we see that as our priorities to then, be able to take or deal with another hit if it hits us.
Just to react to that, I think paying down debt is good, but you must remember that some of the countries that were hardest hit by the crisis were those that had very low debt-GDP ratios. So, look at Ireland, for instance. Its debt-GDP ratio before the crisis was 25% of GDP, and within the space of 3 years, it was up over 120. So, sometimes paying off debt isn't enough. The bigger problem, and one of the things I would like to say is, I'm glad you're worried, because you should be worried, because one of the things we were trying to highlight in the paper is that people really did not understand what type of risks they were facing. And others entered into risks that they didn't understand the consequences of, including my own government, who decided to guarantee the entire banking system, basically, and that was one of the major causes of the problems. So, okay, there was mitigating circumstances, and hindsight is a wonderful thing. But having said that, I think what's important to understand is that when these types of crashes occur, just having sound fiscal position is often not enough. What you really need to do is understand in advance what your level of risk is, and try to identify what is an acceptable level of risk for you to actually incur. Everybody's going to have to face some risk. You can't have a risk neutral position. But what you have to identify is how much risk are you willing to assume, and what the costs of mitigation are, and what type of strategy you're going to actually take and put in place to mitigate those risks. So when I say, and many developing countries have fewer instruments to use than maybe some of the advanced countries, it's basically country specific what you can do. The first stage is identifying the risk, and the second stage is working out what you actually want to do with it, and then deciding how much residual risk you actually want to manage, basically. So you know, I think every country should be worried about the level of fiscal risk, because it has been demonstrated that it has been a big problem and was one of the major causes of countries' deteriorating positions in the last crisis.
Thanks. I'll just be short. I think the big challenge would be to move from hindsight to foresight, from backward-looking to forward-looking, to get some sense of what the picture looks like, more accurate, because in the past we have been behind the curve for most of the time. And how do we get ahead of the curve? That would be a big challenge. Second challenge would be the communication. How do we communicate a lot better? Given an uncertain environment, there's a lot of questions. And so the flows that we have is the result of not really understanding the uncertainty. How do you explain? And therefore a lot more engagement with investors, a lot more engagement even with the rating agencies to better understand what really is happening in our respective economies, because we are best placed to explain what is really happening, especially when it comes to the reform agenda. And I think to do a lot more collaboration, coordination, specifically because the focus is on reforms. It involves a wide range of stakeholders within the respective economies. Better collaboration and coordination across various stakeholders would be key.
Other questions? Yes.
Thanks, Chidam.
I think this is the last question.
Oh, I feel honored to give the last question. Okay, so I would like to give a little comment on Cameroon's experiences. One of the main things I had a sense from a statement from Brian that debt managers don't really have the levers to affect fiscal policy. However, back in Cameroon, for example, there is a debt management committee. So they've put in place a public debt management committee, which basically has a say in, every big fiscal decisions which the government has to make. So there is somebody from the debt management office who attends every single fiscal policy meeting, on any fiscal adjustment meeting, in order to, raise a signal on any, downward debt effects that fiscal decisions can take. So while debt managers might not have, the levers to affect what decisions get taken, I think we certainly can raise the alarm and, let government understand what exactly are the risks which they're taking by taking this fiscal position versus another one. So putting in place public debt management committees, which have as members everybody, people from the economic side, macroeconomic, finance, debt management, is very good in terms of communication and in terms of coordinating action to mitigate risk. Thank you.
This is a very good point. Actually, I would just like to ask Anthony, because also South Africa has in place a few committees, right? They don't call it debt management committee, but maybe you could share, Anthony.
Sorry, there are key committees that, especially to deal with the risks. And so on our contingent liabilities, we have a fiscal risk committee, a fiscal liability committee that makes recommendations to the minister whenever there's a request by any of the entities for a guarantee or support. It is a committee that is chaired by the head of assets and liability management, and the committee can recommend to the minister whether or not we will take on any additional guarantees. That's a very important committee. There's also a fiscal risk committee. So this was fiscal liability committee looking at guarantees. Fiscal risks committee is the broader and looks at the macroeconomic environment and the risks, therefore, to the budget execution. And that also is a committee within the Treasury, involves the key divisions. And then there's, for internal operations of the Treasury, is a risk management committee. So the risk management committee reports to the internal audit, to the audit committee. And so the risk committee is also an interdepartmental within the Treasury, looking at risks operationally within the Treasury in order to execute on the mandate of the Treasury.
Okay, well, thank you. There are still topics that we didn't really even get close, like disclosing the fiscal risk, for example, which would come after quantifying. But this will be for another day. I will not summarize. I think there are several different good ideas to discuss, but we can do that over lunch. So I would like to thank the panelists for a lively, and the participants for a lively discussion. Thank you very much, and see you in the afternoon.